The major regulatory change introduced since the financial crisis has been an overhaul of the capital requirements for banks. Because the one thing that everybody agrees we learned from the crisis is that banks were operating with too little capital, so that when things went wrong, they simply didn't have the reserves to cope and survive without being helped out by central banks and governments. And people wish to avoid doing that as far as possible. So the capital regime has been overhauled in a big way. Some would say maybe it's gone too far and that banks are now required to hold so much capital that they can't perform their economic function. But we'll see how things evolve. There, of course, have also been changes in a lot of other areas too, ranging from rules on derivatives to new clearing and settlement methods, trying to make the infrastructure of the system safer. But I think the capital changes are the most important ones. Regulators and central bankers and economists need to watch very carefully what is going on to be sure that we have set the balance right. And I think that we shouldn't be afraid to pull back if we believe that we've gone too far, if we believe that banks are now overcapitalized and with so much liquidity that actually that is hindering creation of credit and hindering economic growth. Now, in the West, it's too early to say that because, of course, we're still more or less in a recession. I mean, we've crawled out very slowly, but economies in the West are still growing less rapidly than their trend. So we won't know for a while whether, if normal conditions return, the banks are able to play their proper role. In Asia, that's a little bit different because, of course, economies have continued to grow, albeit not quite as rapidly as before. The reform process is still underway because it's one thing to decide on new rules for bank capital, the so-called Basel III rules, and it's another thing actually to implement them around the world. And at the moment, we have a program of implementation which actually stretches out to 2019. So I think the key thing is to make sure that that program remains on track. But there are also lots of other changes underway. In the United States, there is the Dodd-Frank Act, a massive piece of legislation, 2,300 pages, which I'm told no one has read all the way through. And the consequences of that are still being worked through, whether it's the Volcker rule on proprietary trading or the rules on bringing derivatives onto exchanges. In the European Union, there are still major changes underway with some big new directives on the market in financial instruments, for example, or on credit rating agencies, most of which have still not been fully implemented. So there's still a major implementation program to go, and indeed one of the risks I think one can reasonably point to is of some overload on financial firms in trying to cope with all of this change, all these waves of change at the same time. So maybe there's an argument for a little bit of phasing of this change as we move forward.